if some farms do use an accrual accounting system, and but most farms, like I say, use this cash accounting system. Okay, there. I'm going to go forward. I have no idea how these got so confused here. Okay, we're on the farm income statement, and net farm income takes into account all your expenses and your income and calculates the net farm income. That's what Schedule F does. Everybody who raises crops and livestock on a farm files a schedule income, which is Schedule F, which is essentially an income statement. But what we need to do is make some accrual adjustments to that income statement in order to credit the production to the actual year it was produced. It's not as good as an actual accrual system, but it comes pretty close and is a lot better at actually signing profitability in a particular year. Okay, and it's based and built with supporting information from the schedules that are on a balance sheet, and those schedules on a balance sheet are under. You can use a pre-printed balance sheet, a paper balance sheet, which you can find as part of, I believe the balance sheet is included in our textbook on the DVD that's part of our textbook. There's all kinds of sources, both computerized and paper balance sheets. And under all these balance sheets, many of these balance sheets include a full schedule of subcategory, a schedule of inventories for livestock, inventories for crops. They also include the categories of bills that are payable and accounts receivable. So you can see on this sample income statement on this side all the schedules that are referred to, and all an accrual adjustment does is take these schedules. These schedules come off of the ending and beginning balance sheets. So crops held for sale, let's just use that for example. The ending balance sheet will have a value and the beginning balance sheet will have a value. And the difference between that value, in other words, if more crops are held at the end of the year than at the beginning of the year, then those crops could have been sold, so they need to be credited to the farm income for that year in order to correctly assign the production to that particular year. Otherwise, if you hold them in inventory and don't make any adjustments, the farm will show lower income than it would have shown had those been either sold, or in this case we just make adjustments in the inventory. And that's done for accounts receivable, accounts payable, down here on the expense adjustments for investment in growing crop, prepaid expenses, accounts payable, and taxes and accrued interest. So these adjustments make it possible that we can turn this, which is the basic form of a Schedule F or an income statement, into an accrually adjusted income statement and really account for net farm income that is the actual net farm income for the farm for that production year. If you're going to do anything, start with this. Start with the beginning and ending balance sheet, and then include an accrually adjusted net farm income statement. And I don't mean to say if you're going to do anything, because I know you're all going to do something. And we all start out our year with the best intentions, but this would be a great one to start with for your New Year's resolution. And I'm afraid that somehow these got in the wrong order, but I'm going to go ahead and move on to the cash flow statement because I'm going to run out of time otherwise. And the cash flow statement explained if you can have a healthy balance sheet and pretty high net farm income, but that doesn't necessarily mean that you can meet your financial obligations for the coming year. The cash flow statement has two purposes. We can put together a cash flow statement for the looking backwards at the particular year we're in and explain how the cash flow went through the business in that year, or we can use the cash flow statement as a budget for the upcoming year. And both are recommended. You should have a cash flow budget statement as a budget for the upcoming year, but you should also compare back with the year that you just did, that you just completed. The cash flow statements includes everything that goes through the farm, and doesn't only include all the cash that flows through the farm. It doesn't only include income, expenses of production, but basically all cash expenses that go through the farm. It's important to include them all because even though they may not be farm expenses, they have to be covered by either off-farm income or on-farm income or borrowings from bank sources. I'll hopefully show you what a cash flow statement looks like. This is okay, everybody listening, you're probably going to say, wow, he was really confusing. I really apologize for this. I don't know exactly how these slides got in this kind of order, and I'm not, I don't know. But anyway, if hopefully we'll come back to what a cash, let me see if I got that cash flow statement. Okay, so I don't have an actual example of a cash flow statement. Cash flow statements organized by income and expenses, and they can be organized. They can be organized monthly. They can be organized quarterly, and they cover a period of the year, usually a calendar year. There's also another statement, another organization of the cash flow statement called the Statement of Cash Flow, and all that does is organize cash flow by operating activities, in other words, producing activities, investment activities, which would be financing, purchase and sale of equipment, for instance, or breeding livestock, and then cash flow from financing activities, which would be selling proceeds from a loan, or cash flow from payment of a loan. So another organization of that. Okay, let's see. The cash flow statement is usually required by any bank if you're going to look, particular if your particular product that you're producing. If you are looking for funding for that and the banker doesn't understand it, the cash flow statement is organized in such a way that it includes pretty much the year-long needs of the business for cash, but also implicit in that is the the production steps that you're taking in your farm business throughout the year. So very important. And number 3 of the financial statements we're going to talk briefly about today. The statement of owner equity is the final one. I include this statement of owner equity because we all have things happen in our lives, in our businesses, in our farms that aren't explained necessarily by just the balance sheet, and they can include withdrawals, they can include inheritances through contributions. Contributions might include inheritances or capital contributions from people in the business, retained earnings within the business through net income. They can include distributions, gifts to heirs out of the business, for example. And these will not necessarily show up on the balance sheet, but need to be accounted for, or excuse me, they won't necessarily show up on the net income statement, but they need to be accounted for to help show the difference between owner equity on the beginning balance sheet and owner equity on the ending balance sheet. And this is what a statement of owner equity looks like. In this particular example, we start with net farm income, and then there's an increase in deferred income taxes, and then owner equity. We started with owner equity on say 2013, January 1. And then we adjust by net farm income, which is added to the owner equity. We adjust owner withdrawals for family living, non-farm income that's contributed to the business. We also adjust for, in this case, they're including market change in market value of assets. And you can if you're holding your balance sheet by market values, then you need to include that. If you're just using cost values, then you would need to include those changes in market values. And it all depends on your main purpose of maintaining the use of the balance sheet. So that explains the difference between this ending balance or beginning owner equity and the ending owner equity. And I mentioned that it can include things like disbursements, capital disbursements. It can include other capital contributions from farm businesses and other capital distributions. So those could be gifts, etc. And probably the least used of the four financial statements we're going to use today. But particularly as businesses, farms become more and more complex, this statement does help explain what happens between that beginning and ending balance sheet. I'm just going to use about 4 minutes I have left here to talk about, summarize this through, this is my first lender, and his name's Dale Kinzel. He was with Farm Credit, and he gave me this advice as I began to work in farming agriculture years ago. And the first one, he has 5 keys to success. The first one was have realistic expectations what your farm business can do. You know, do some sensitivity analysis on prices and be realistic about what your marketing, what your markets can reasonably return. One thing he suggests is beware that if you're not living on depreciation. In other words, and Stan, you mentioned about your tractor, and maybe this is an example that one of these days that tractor's going to have to be replaced. It's doing for you what it needs to be done now, but I know that if you have machinery on your farm, although this might be not as true for direct market types of farms because there is less dependency on machinery, but some farms have lived off their depreciation and not been realistic about what the farmer is returning. They're taking too much out for family living and not replacing those costs for machinery and